Now let us start. Okay, the second one. Second one, it is market borrowing or simply public borrowing. We have discussed the first one, borrowing from the RBI. When Government of India is borrowing from RBI, money supply is going to increase and it will lead to demand for inflation. This time, in second case, government decides to borrow from the common people. And here, on behalf of the central government, the debt manager of the government, is RBI, will be issuing its securities to the common people. And the people of India, like we people, so when we buy government securities, it simply means we are giving loan to the government. Now, government is getting loan from we people for what? To meet the expenditure, and that money will be again spent by the government. So money will come into the market again. So overall, what we can see here, in case when government goes for market borrowing, is impact on the money supply. Money supply in the country, it will remain the same. It will either increase or decrease. See the complete process. The government issued securities to the common people. Okay. When we people of India, we are investing in those securities, so money is going to come from the market into the pockets of the government. So in the market, money supply will come down by ₹100. Why government is getting loan from we people? To meet the expenditure. So again that money will be spent by the government. So that money will again come into the market. So purpose of the government is over. Government is able to meet the expenditure. Okay. But what about the money supply? So money supply here is going to remain the same. Okay. Firstly, when we buy, money is coming from the people into the pockets of the government, and when the same is spent by the government, again that money is coming to the market. Okay. So in second case, money supply is going to remain the same. Okay. For government, does it make any difference? No. Okay. It doesn't matter whether the government is borrowing from the RBI or from the market. Okay. Government, for the government, is basically debt. Okay. Debt instrument, and in both the cases, government is liable to return the money back along with interest. Okay. Now there are two types of securities. Okay. They are issued by the RBI, and this market where government securities are sold and purchased, it is known to be open market operation. Open market operation. Open market operation, where RBI is either buying or selling government securities. Open market operation, the market where securities of the government, they are being sold, they are also called gilt market, or simply gilt is market. Gilt basically is English word, and gilt means degree of highest securities. Okay, because when we give loan to the government after purchasing its securities, what about the safety of the money? So our money is 100% safe, and that's why government securities among the common people, they are very, very popular, very popular, and it has been exercised by the government since 1951 till today. Okay, so when government goes for, government securities, they are in the nature of debt. So there are two concepts. Okay, bill and bond. Bill and bond. Bill and bond both are of in the nature of debt, but there is a technical difference between bill and bond. If the maturity period of the loan is 1 year or less, then we use the word bill. But if the maturity is for more than 1 year, then it is called bond. When we see the concept of developed country, so there, three concepts are there. In developed country, if the maturity period is 1 year or less, they use the word treasury bill. If the maturity period is in between 1 year or 10 years, then they use the word treasury note, and if the maturity period exceeds 10 years, then it's a treasury bond. Okay, but in India, there are two concepts only, treasury bill and treasury bond. Let us go to treasury bill. Treasury bill and treasury bond, or simply, both are debt instrument and both are issued to get the loan for the government by the RBI. But the maturity period is 1 year or less. If it is treasury bill, short term, and long term, exceeding 1 year maturity period, then it will be called bonds of the government, treasury bill, treasury bond basically. Now first come to treasury bill. Treasury bill. So treasury bill in India, they are basically of 3 maturity period. Treasury bill in India, And remember, this Treasury Bill is known to be a regular Treasury Bill. Okay. Ad hoc Treasury Bill we have discussed. It was exercised or used, okay, in case of deficit financing. Here, the Treasury Bill that is being used, okay, it is right now, it is for three maturity. One is called 91 days, okay, second is 182 days, and third is called 364 days. First, I am discussing the concept of Treasury Bill. This is known to be a regular Treasury Bill. Okay, regular Treasury Bill of three maturities, they are being issued by the RBI on behalf of the government. 91 days, approximately 3 months, 182 days, approximately 6 months, and 364 days, almost 1 year. But in the examination, never use 3 months, 6 months, or 1 year, because interest is calculated on daily basis. So always use the word days, 91 days, 182, 364. In all the three cases, what we can say, maturity period is less than 1 year. Now, bonds, they are also debt instrument. They are also issued to the common people. Purpose is the same, to get loan from the public. But remember, there is a basic difference. Treasury bill, they are issued at a discount. At a discount, there is no interest provided on Treasury bill. But in case of bond, they carry fixed rate of interest. So let me now explain the concept of Treasury bill, how it is working basically. So Treasury bill basically, they fulfill the short-term financial need of the government. It is in the nature of short-term. So Treasury bill, you will not be getting, the buyer of Treasury bill, they won't be getting any interest. But still, some return there. So return is in the form of discount. What is the discount? Let me now discuss by taking another example. See, Treasury bill, suppose the face value of the bill is ₹100. Face value of Treasury bill, it is 100. Face value, this is also called print price, that is called nominal price, that is printed on its face. So suppose the face value of Treasury bill, it is 100. So they will be issued at a discount, that is called issue price. So let me, I said, discuss by taking another example. Suppose I need money. And I am issuing you people, some security for 4 years. For 4 years, the nominal price or the print price of that security is ₹100. After 4 years, you will get your money back. But you won't be getting any interest. So then what is the return? So face value, it is 100, but they will be issued to you by me at a discount. So right now, suppose discount rate is 30%. It means for every one security, you will have to pay only ₹70. But face value is 100. For the next 4 years, you won't be getting any interest, but on maturity, I will be giving you ₹100. And you must have heard the name zero coupon bond. The same is the feature. Zero coupon bond, they don't carry any interest. But still they are very popular. The reason being, here they are issued at a high rate of discount, and that discount is going to be your income. So same case is applied, same thing is applied in case of Treasury bill. Treasury bill holders, they don't get any interest. But Treasury bill, they are issued at a discount. So let us now explain the complete process. So face value of Treasury bill, it is ₹100. Now what about the issue price? Issue price means the price at which it is being issued. So suppose issue price is only 80. See, there is a difference. Face value is 100 and issue price is only 80. It means at 80 rupees only RBI is issuing. So investors, they will have to pay only 80 rupees to get one bill. You will not be getting any interest, but on maturity, you will get 100 rupees. So 20 rupees is going to be your gain. Is that clear now? Okay, coming back to Treasury bill. So Treasury bill, particularly, it is being sold through auction. Through auction, for example, 91 days maturity period Treasury bill. Here auction is held on weekly basis. Weekly basis. I repeat again, face value is 100, and you know the process of auction. Then bidding will be there. Okay. And whatever the highest rate is, suppose highest rate is rupees 80, it means okay, for every one treasury bill, RBI will get 80 rupees. Okay. And yes, but on maturity, investors, they will get 100 rupees. Okay. The treasury bill, they don't carry any interest. They are issued okay, at a discount. Okay. And the difference between the face value being the higher, face value and the issue price means the price at which it is being issued okay, is going to be your return. Now the question is, who can buy treasury bill? Who can buy treasury bill? So anyone okay, in India can buy treasury bill. Okay, it can be purchased by we people in our individual capacity, maybe okay, some company, maybe trust who are set up for investment purpose, and particularly it's very popular among okay, commercial banks and cooperative banks, because when they buy treasury bill, okay, they are able to include in the statutory requirement of SLR. Okay, have you heard this name? A statutory liquid ratio. When I discuss the monetary policy, I will discuss that banks, they have to maintain, right now the rate is 19.5%. They have to maintain SLR, okay, at least 19.5%. It's a legal requirement. Okay, and SLR money to maintain the liquidity, okay, SLR is necessary. It's a force measure by the RBI, and every commercial bank and cooperative bank, they have to keep or maintain 19.5% of their total net demand and time liability as SLR. Okay, to maintain their liquidity. Now, SLR money, as you know, SLR money can be kept in the form of either cash, gold and government securities. Okay, so when they buy, okay, commercial banks and cooperative banks, so when they buy treasury bill, that treasury bill, it is included okay, in that SLR limit. Okay, so they, after buying okay, this treasury bill, they are able to maintain the SLR limit as well. So question is, okay, who can buy? So anyone can buy. So open to all, okay, open to all. And yes, okay, this is the concept. Now bond is basically to be called technically treasury bond. Bonds, they are very popular. Okay, they are issued throughout the world. Bonds are issued throughout the world. Okay, and yes, bonds, they are also of various types, but one thing is common, they carry fixed rate of interest. Okay, and the bonds issued by the governments. In India also, you can say, okay, various types of bonds are being issued. Electoral bond, you can say masala bond, you can say inflation index bond. So throughout the world, more than 150 types of bonds are issued. Okay, bond is also coming under debt instrument. Okay, and it will carry, they are not issued at discount. Okay, yes, okay, but it will carry fixed rate of interest. Fixed rate of interest. Okay, so when okay, bonds are issued, throughout the world, okay, bonds are issued by every government. It's not that only Indian government is facing the problem of deficit. Okay, deficit is being faced by most of the countries of the world. Okay, so everywhere you can see, American government also, they issue bond. European government also, they issue bond. Every government is issuing bond. So bonds issued by the commercial bank, government, it is known to be sovereign bond. Okay, sovereign bond. Collectively, it is called sovereign bond. Okay, yes. So bonds issued by the government, okay, throughout the world, collectively they are called sovereign bond. Okay, yes. Okay, so sovereign bond. Similarly, one more concept is there, that is called quasi sovereign bond. Now, quasi means partial. Okay, so these bonds, okay, these bonds in Hindi you can say Ardha Sarkari. These bonds are issued by some other agency, but they are backed by the government. Backed by the government. Okay, it is going to help that organization to raise the money from the public. Last year, Indian Oil, okay, and other companies as well, they went for issue of quasi-sovereign bond. But we are concerned with okay, sovereign bonds issued by the government. I hope you got the difference between bill and bond. Okay, bill and bond, both are debt instrument, and yes, purpose of issue of these two is to get loan, but they are different from each other. Bonds, they carry fixed rate of interest. They are always issued at issue price. Okay, they are always issued at face value, means print price, the nominal value. But the treasury bills are simply treasury bills are issued only for less than 1 year, and they don't carry interest. They are issued at a discount, and the difference between the nominal price and issue price is going to be the return for the investors. But our concern is second, borrowing from public. Market borrowing, public borrowing. Later on, you will come to know that whatever market borrowing is taking place to finance the total expenditure of the government, it is known to be fiscal deficit. Known to be fiscal deficit. Fiscal deficit in India includes only market borrowing. Disinvestment and other receipts, they are never part of fiscal deficit. So, meaning of fiscal deficit is very simple. Contribution of borrowing. Borrowing means market borrowing. Contribution of borrowing in total expenditure of the government. That is called fiscal deficit. If fiscal deficit is increasing, it means the contribution of borrowing in total expenditure of the government, it is increasing, and it's not a good sign. It also means that government's own incomes, tax versus non-tax and other income, their share in financing the total expenditure, it is falling. So when fiscal deficit is increasing, the burden of interest on the government is going to be more. And yes, fiscal deficit is said to be the best indicator of the performance of a country on internal front. If fiscal deficit is increasing, yes, the credit worthiness of the government will be less. Moreover, if the fiscal deficit is increasing, the international rating agencies, they are going to downgrade the rating of India. It is not a good thing for India. Reason being, then it will not only hurt foreign investors as well as domestic investors as well. So this is the problem, we can see. Anyway, but one thing is positive. Let us make a comparison between borrowing from the RBI and second, borrowing from the market. So one thing is clear. When government is borrowing from the RBI, we people of India, we don't have any role to play. It's a matter between central government and the RBI. But whenever central government is borrowing from the RBI, money supply will increase. And yes, money alone is sufficient to create a gap between demand and supply, and it led to demand pull inflation. But when government decides to borrow from the market, in that case, overall money supply in the country is more or less going to remain the same. It won't increase the money supply. So from here, it seems that borrowing from the market is better than borrowing from the RBI. Right now, you may be correct. But let us now say the negative side of market borrowing. Negative side of market borrowing. So market borrowing at present, it is one of the major source of finance for the government. When we see the budget of this current year, 2020-2021, presented on the 1st of February, the target of market borrowing, it was 7,96,000 crore. 7,96,000 crore. It means just touching 8 lakh crore. For the current year, government will borrow approximately 8 lakh crores rupees. But what has happened for the last 3 months, you can see government resources are falling, tax revenue, it has come down drastically. So definitely government, and moreover on the other side, government's total expenditure is increasing. So somehow government will have to manage more money. So target for borrowing, market borrowing set, it was hardly 8 lakh crore. But now it is reported recently that now government has decided to borrow 4 lakh crores rupees more. It means till now, the actual borrowing for the current year, it will be more than 12 lakh crores rupees. It means fiscal deficit of India, it will be higher than what it was targeted, 3.5%. And moreover, it's not a good sign. As a result, you can see, since fiscal deficit, in my opinion, it is going to exceed 10% of GDP. Moreover, since fiscal deficit borrowing, it is expressed in terms of GDP, and GDP has also come down. So when GDP has come down in percentage term, it is basically equal to borrowing divided by GDP. So if borrowing as a percentage of GDP, fiscal deficit, borrowing as a percentage of GDP. So borrowing as a percentage of GDP, yes. So what is happening right now? Borrowing is increasing because government lacks resources, and moreover, GDP growth rate has come down. So because of these two, in percentage term, fiscal deficit is going to be very, very high. And I said, that's why I said it will be more than 10% till now. It may be more, it may be less, depending on what will happen in the next 6 months. Anyway, So coming to this, okay, so fiscal deficit of India, definitely it is going to be very, very high. But okay, you can give the excuse, it's not a normal time, it's basically some sort of emergency time. Okay, so that on that ground, you can say, okay, government can be given, okay, the clean sheet, no other option. So coming back to, okay, the negative side. Okay, so market borrowing and borrowing from the RBI. Okay, yes, two things we have discussed, borrowing from RBI and borrowing from market. So till now, okay, you can say that borrowing from RBI, okay, sorry, market borrowing is better than borrowing from the RBI because, okay, in the first case, in case of market borrowing, money supply in the country is going to remain the same. It won't change. Okay. I said you may be correct, but okay, let us now see the negative side of market borrowing. Now we have to okay, analyze okay, in detail okay, the pros and cons of market borrowing because it is presently it is our one of the main source of okay, generating resources, and yes, it is increasing. So it will have okay, its impact, maybe positive, maybe negative. So I am going to discuss. Now, borrowing from, isn't this subject in economics? All the things are interrelated. And that's why you cannot discuss the things in isolation. Okay? Never try to discuss things okay, separately. Try to make out a link, then only you will be very, very comfortable. Now, borrowing from RBI, okay, although it has gone, okay, borrowing from RBI, it is coming under monetary policy. Market borrowing, it is coming under fiscal policy. But these two, they have a link with another topic, and that is called, okay, that is called inflation. That is called inflation. Okay. Inflation broadly, they are of two types. Okay. First is called demand pull inflation. Demand pull inflation. And the second is called cost push inflation. Okay. Other types of inflation like structural inflation, okay, like speculative inflation, so they will be discussed later on. Let us see the two main okay, types of inflation. First is called demand pull inflation and cost push inflation. Now market borrowing and borrowing from the RBI, okay, both have the link with these two. Okay, yes, because we have to see okay, every side. Okay, demand pull inflation, okay, as the name suggests, okay, demand pull inflation is mainly because of the mismatch between demand and supply. Okay, yes, demand is being pulled up. Okay, it means leaving the supply behind, demand is being pulled up. So there is a huge gap, and that gap will lead to inflation. Okay, so demand pull inflation is mainly because of the mismatch between demand and supply. Okay, if the gap is more, rate of inflation will be further high. What causes demand pull inflation? Okay, so first and the most okay, significant factor is excess money supply. Excess money supply. Okay, again I repeat the same. Okay, money alone can increase the demand, but money alone cannot increase the supply. Okay, yes, RBI's main objective of the monetary policy is to maintain to regulate the money supply. Let us supply money into the market in such a manner so that equality between demand and supply can be maintained. If it's a case of excess money supply, it will hurt the economy. If it's a case of less money, it will also hurt the economy. This we have recently seen after demonetization. Because after demonetization, money supply of Indian market suddenly reduced by 86%, and as a result, economic activity suffered. Okay, so money alone can be very, very constructive as well as very, very destructive. So demand for inflation, the first and the main reason is excess money supply. And that's why people of India, some people they think that why don't RBI is printing the notes and distributing among the common people? So yes, problems are going to be solved because income will be generated for everyone. That is not the case because it will lead to creating gap between demand supply. The first and the main reason is demand pollution is basically gap between excess money supply. Now the first one, first one, deficit financing. What happened? Deficit financing policy of the government of India in the past, it led to excess money supply into the market, and thereby gap was created between demand supply. It has started basically by late 50s or early 60s, but the gap that was created, you can still see that gap is prevailing. Another reason is increase in population. So when population is increasing, demand will keep on increasing, particularly of the basic goods. Okay, and if the supply is not responding, you will have gap between demand and supply. So first is called demand pull inflation. So first, borrowing from the RBI. Borrowing from RBI, deficit financing. Okay, deficit financing India led to demand pull inflation. Demand pull inflation. So final, I am concluding, demand pull inflation is mainly because of the mismatch between demand and supply, provided demand is more than supply. Now come to the second one. Second one, and everything we have to link with Indian economy. Okay. Now, question is, okay, if demand is more than supply, if there is a gap between demand and supply, provided demand more, okay, so definitely you will have inflation. But is it possible that demand and supply both are still equal? There is no mismatch between demand and supply, still prices are rising. Okay. Listen to me carefully. Okay. If there is a gap between demand and supply, provided demand is more than supply, definitely you will have inflation. But is it possible that demand and supply both are still equal? There is no mismatch between demand and supply, still prices are rising. Okay. So yes, it is possible. Okay. And that is called basically, why it is possible? Because your production cost is increasing. Production cost is increasing. Okay. Yes, cost of production. Suppose I am a producer, I am making this pen. My production cost is rupees 10. Rupees 10. And suppose 2 rupees profit I have added, ignore taxes. So the minimum price I have to fix is a 12. Okay. Now because of some reason, my production cost has increased. Because of some reason, my production cost has increased, okay, to 15 rupees. So now I will have to, okay, sell this pen to have a profit of 2 rupees only, for rupees 17. I will have to increase the prices to cover the cost. Okay, so price of this pen has increased from 12 to 17. It's not between mismatch between demand and supply. It's mainly because the production cost of this pen has increased, okay, from 12 to 10 to 15. Okay. So let us now see the cost push inflation. And yes, okay, right now you can see, okay, what is happening in India. To make the things clear, I will go to the basic example. This example, and yes, cost push inflation. Cost push inflation. Okay. So there are 4 factors of production. 4 factors of production. Okay. Let us take a very simple example. Factors of production. So there are 4 factors of production. Land. For land, we pay rent. To the labor, we pay wages. For capital, we pay interest. Okay. And to the entrepreneur, okay, we pay profit. We pay profit. Okay. Okay. Now the product is ready. This is known to be factor cost. This is known to be factor cost. So suppose we have paid 2 rupees each. This example I have discussed earlier. Okay. So what is the factor cost? 8 rupees. But when it is coming into the market for sale purpose, in between who comes? Government with the taxes, and here indirect taxes of rupees 2. So making the market price rupees 10. Okay. It's a very simple example. I started the classes by taking the same. I'm assuming I am making this pen. Okay. And these 4 factors of production, they are basically helping raw material getting converted into finished goods. And yes, okay, land, labor, capital, entrepreneur. And to them, to the person providing land, we are paying rent. Okay, so 2 rupees rent was paid. To the labor, wages of 2 rupees were paid. Then for capital, we are paying interest of rupees 10. Okay. Regarding interest, it's very interesting. Okay. Interest is an integral part of cost of production. I repeat again. Interest is an integral part of cost of production. If the rate of interest is increasing, production cost will also increase, and vice versa. Remember. And interest is the only factor which is common between RBI's monetary policy and Government of India's fiscal policy. Later on we will discuss. In the recent times you can see, okay, war is going on between central government and RBI. Okay. So what is the main factor? That is called interest. RBI is working on inflation theory. Okay. So to check the inflation, RBI used to increase the rate of interest. But the Government of India is working on growth theory. Okay, so what government of India is trying to do? Okay, to promote growth, it is trying to bring the rate of inflation down. Okay, so regarding interest, tug of war is going on. Okay, so these things are very interesting. Later on, when we discuss the current issues, everything I will discuss. Okay, coming to the basic thing first. Okay, so rent 2 rupees, wages 2 rupees, interest 2 rupees, profit 2 rupees, and yes, taxes 2 rupees. So market price is 10. So this price, okay, the market price of this pen is going to be 10. Now, inflation is always calculated at market price. Inflation is always calculated at market price. Okay, market price of this pen is rupees 10. The pen, okay. Now, this 10 rupee is basically inclusive of these 5. If any of the 5, okay, is increasing, okay, then what will happen? Market price is also going to increase. Okay, these are the payments made to the factors of production. I said, okay, if any, okay, among these 5, okay, is increasing, so what will happen? It will increase the market price. So let us see one by one. Okay, cost push inflation. What are the factors? Okay, and particularly, okay, with respect to Indian economy, the first reason behind cost push inflation is raw material. If raw material is getting costly, what will happen? Production cost will increase. Yes, and when production cost is increasing, what will happen? Producers are forced to increase the prices. Okay, now cost of input raw material is because of both reasons. Okay, domestic as well as international. See the case of crude oil. Price of crude oil is fixed in the international market, and where government of India's policy has no role to play. In the international market, you can say price of crude oil keeps on changing, sometimes very high, sometimes very low. So suppose in the international market, price of crude oil has increased. So what will happen then? Okay, definitely it is going to inflate the economy, because no subsidy on the part of the government, and all companies, then they will have only one option to raise the prices of petroleum and petroleum product, and leading to high input cost, leading to inflation. Okay, so first reason is raw material is getting costly. Okay, second is, okay, if the rent, okay, is increasing, rent is increasing, if you have to pay, okay, those business people who are working on, okay, rental basis, they don't have their own premises, and normally, okay, so when they have taken some building, some factory on rent, so there is a rent agreement. So normally rent agreement says that every after 11 months rent will be revised, okay, by maybe 10%, maybe 5%. So if you have, being the producer, if you have to pay rent at a high rate, okay, what will happen? Your production cost will also increase, and then you will have to, okay, increase the prices. So second reason is, okay, rent. Okay, next is wage rate. Okay, wage rate. Now in India, wage rate is very high. Very high. Okay, wage rate, labor is very costly. Okay, labor in India right now is costly. Okay, reasons are so many. You can see trade unions all the time. Okay, all the time. Okay, they are going for strike. Reasons, you know, okay, but the main reason known to everyone. And a strike will be called off only when, okay, wage rate is increased. Moreover, okay, in the organized sector also, you can see government of India time to time is going for increasing the wage rate. Okay, see the case of Manrega, where wage rate, according to the inflation index, wage rate is increased time to time, okay, to compensate for the losses. So when wage rate is increasing, what will happen? Okay, you will have to pay at a higher rate. So as a result, your production cost will be more, okay, making the, okay, yeah, leading to cost inflation. Okay, interest I will discuss in the end. And then now in India, market imperfection is there. Okay, it is true to say that without profit, business cannot be done. But profit margin should not be, okay, extraordinary, or simply, okay, monopoly profit should not be there. But in India, what we can see, big producers, those companies whose goodwill is very good. Once they have the goodwill, the first thing they do, they increase the prices. They increase the prices. And people of India, okay, they are ready to pay for that, okay, because for them, name matters, goodwill matters. So profit margin in India cannot be called normal, cannot be called genuine. Yes, okay. Producers, particularly big producers, okay, big companies, blue chip companies, whose goodwill is very good. So they are simply exploiting the people of India by charging high percent. And when Indian people, when they pay, okay, at a high rate, they feel proud over that. Okay, they link it with their status symbol, but they don't know. Okay, they are basically getting exploited. Okay, by these companies. They are helping this company to exploit you. Okay, so profit margin, if it is increased, okay, yes, what will happen? If profit margin increase, yes, you will have cost pressure inflation, prices are going to increase. So yes, it is also one of the reason. Okay, next comes, okay, three things we have discussed. Okay, next comes government. Okay, behind cost pressure inflation, government of India or both the governments, okay, they are also responsible. Okay, time to time what we have seen, government has, okay, kept on increasing the tax rate. Recently you have seen government, both the government, central government as well as state government, so both have increased the tax rates on petroleum product. And yes, despite falling prices in the international market, within India, price of petrol and diesel is increasing. Then what happened after GST? I told you earlier, Indian people, they are spending maximum on services. Maximum services? Yes, okay. Or what happened after GST? When GST came, service tax rate was 15%, and under GST, it was merged with 18% rate. So all the services, they have become costly. Okay. So in India, government's taxation policy is one of the major reason behind, yes, okay, cost push inflation. Okay. You cannot excuse the government. You cannot give clean sheet to the government. Yes, what we have seen, even today, the average tax rate in India is higher than the global average. So government is also responsible for this high prices. Okay. So yes, okay, this we have discussed. Now come to the interest factor. From here, always questions are coming. Okay. Interest we pay as a cost of capital. Okay. And interest is an integral part of cost of production. If the rate of interest is increasing, your cost of production will increase. Again, it's very interesting. Interest is basically the only thing common between the RBI's monetary policy and government's fiscal policy. Okay. And there is some controversy, some war is going on, okay, all the time. Okay. Because central government, RBI, is working on inflation theory. I told you earlier. Now to check the inflation, it is always trying to increase what? Rate of interest. Okay, so whenever rate of inflation is high, what RBI will do? RBI will increase the rate. On the other side, Government of India is working on growth theory. And for growth, what is needed? Availability of cheap and sufficient capital. I repeat again. For growth, one of the conditions is availability of cheap and sufficient capital. Cheap capital means rate of interest should come down. Okay. So in order to promote growth, Government of India, what it wants RBI to cut the rate. Okay. So both are working in the different direction, and this is the major reason. So interest basically is a common factor between RBI monetary policy and Government of India's fiscal policy. But yes, let us now discuss interest in detail. Okay. If the rate of interest is increasing, your production cost will also increase, leading to cost push inflation. So what is exactly happening in Indian market? So let us now discuss in detail. Okay. Yes.